In this video, we're going to be discussing taxes, specifically in the United States, and how it all works. Before I get started, I do want to recommend that you speak to a tax professional for final advice. Just use my information as an example and strictly for educational purposes. So what I'm going to do is I'm going to give you 3 individual scenarios which should apply to every situation that you should be a part of when trading in cryptocurrencies. So for scenario 1, let's just say that you have bought your first Bitcoin and you spent $100 to buy Bitcoin, and then you sold it for a profit after 6 months of holding it for $150. So you made a $50 profit. On that profit that you've generated, you would actually become liable to pay a short-term capital gains tax. And that tax rate is actually at your normal income level. So whatever you're currently paying right now for your taxes, you would be taxed that same amount, specifically on the capital gains, the profit in this case of $50 that you had made with your crypto trade. Now, it's important to know that this is only applicable if you trade in a 12-month period, within a 12-month period. If you wait longer than 12 months, that's when the game changes, and I'll give you an example coming up in just a moment. Before we resume the video, if you still need a personalized discussion, schedule a one-on-one call with us at decryptcrypto.net, and we'll be here to support you on your journey. With that being said, let's get back into the video. So now in scenario 2, this one is where it gets pretty interesting. You probably heard about people who are doing things such as wash trading, and why they do wash trading is to realize losses on the books so that they can say to Uncle Sam, I've made X amount of loss and therefore I shouldn't be paying taxes. Now in La La Land, that sounds absolutely all well and good, but unfortunately in reality it doesn't quite work like that. So there's 2 situations that occur. Either you're married or you're single, or you might be married but you're filing individually. In the first case, if you're married and filing jointly with your spouse, what would happen is that you can actually write off up to $3,000 of total loss from your taxes. However, in the second situation, if you're an individual filing for yourself only, then you would only be able to write off up to $1,500, and that's it. So just to summarize, $3,000 if you're married and $1,500 maximum write-off from your normal taxes if you're submitting this as an individual. So scenario 3 is of course the best situation that you want to be a part of. So in this situation, let's just say you bought Bitcoin today and you sold it in 13 months from now, basically after 12 months. That is considered as long-term capital gains, and as a result you pay less taxes on that after you sell. So in this case, if I bought Bitcoin today using $100 and in 13 months from now it's worth $150, that $50 profit I would be subjected to capital gains, and that capital gains amount is anywhere between 0% all the way up to 20%. It's important to know that the average is about 15%, so we expect to pay about 15%. And then also for scenario 4, what I actually didn't include in this is, let's just say you sold for a loss after 13 months. That would basically fall into the exact same situation as scenario 2. You wouldn't be able to do any more than $3,000 write-off or a $1,500 write-off whether you're married or filing individually. With that being said, this information was strictly for educational purposes so that you can get a very simplified understanding of how taxes work in crypto. But with that being said, speak to a tax professional. If this content was helpful for you, leave a comment and subscribe to the channel for more content like this. Have a great day.